The financial markets have always been ruthless. Long before the age of digital trading platforms, social media hype, and algorithmic execution, the market tested traders in the most unforgiving ways imaginable. In that brutal environment, one name rose above the rest, not because he predicted the future, but because he understood risk better than anyone else. Jesse Livermore was not just a trader, he was a survivor of the market's harshest lessons. Livermore's life was a cycle of extraordinary success and devastating failure. He made millions when millions were almost unimaginable, and he lost fortunes just as quickly. But buried within those extremes was a truth that modern traders still struggle to accept. Trading is not about making money first, it is about not losing it. This belief shaped what later became known as Jesse Livermore's risk management philosophy. The first and most fundamental rule Livermore lived by was capital preservation. He believed that money was a trader's weapon, and once that weapon was gone, the battle was over. No strategy, no indicator, and no amount of confidence could compensate for depleted capital. This is why he never allowed a single trade to threaten his survival. He understood that the market does not reward bravery. It rewards discipline. Livermore's second rule was brutally simple: cut losses without hesitation. He believed that the moment a trade proves you wrong, it is no longer your trade. Many traders argue with the market, convincing themselves that price will return. Livermore refused to engage in that argument. He accepted that being wrong was part of the business. What mattered was how long you stayed wrong. Another critical risk rule was never to average down on a losing position. To Livermore, this behavior was financial suicide. Adding to a losing trade meant increasing risk while ignoring the clearest signal the market could give, that your idea was incorrect. Instead, he believed in adding to winning positions, where the market itself was confirming his judgment. Livermore also emphasized the importance of position sizing. He understood that risk is not only about direction, but also about size. A correct idea executed with excessive size could be just as destructive as a wrong idea. He adjusted his exposure based on market conditions, volatility, and clarity. When uncertainty was high, he traded small. When conviction was high and the market confirmed his thesis, he increased size, but never recklessly. One of Livermore's most powerful rules was patience. He often said that money is made by sitting, not trading. Most traders feel the need to be active, mistaking movement for progress. Livermore knew that overtrading increased risk without increasing opportunity. He waited for conditions to align perfectly, and when they didn't, he stayed in cash. To him, cash was not inactivity, it was protection. Emotional control was another pillar of his risk management system. Livermore understood that fear and greed were the true enemies of traders. Fear caused premature exits, while greed caused traders to hold positions too long or take unnecessary risks. He trained himself to follow rules instead of emotions. When he failed to do so, the consequences were immediate and severe. Livermore warned strongly against trading based on tips. He believed that following others removed accountability. When traders rely on tips, they don't truly understand the risk they are taking, and when the trade fails, they blame the source instead of themselves. Livermore believed that true risk management begins with personal responsibility. He also respected market trends deeply. Fighting the trend, in his view, was an unnecessary risk. Trends represented collective market behavior, and attempting to outsmart that behavior was dangerous. Livermore didn't try to predict tops or bottoms. He entered after confirmation and exited when the trend weakened. This approach reduced uncertainty and aligned risk with probability. Another overlooked risk rule was knowing when to stop trading. After significant wins or losses, Livermore often stepped away from the market. He knew that emotional extremes impaired judgment. Walking away protected both capital and mental clarity. Many traders blow up accounts not during losing streaks but after winning streaks, when overconfidence leads to reckless risk-taking. Livermore also believed that markets punish stubbornness. If a trade didn't work, he exited without regret. Ego had no place in trading. The market did not care about past success, reputation, or intelligence. It responded only to price action. Accepting this reality was essential to controlling risk. Perhaps the most tragic lesson of Livermore's life was that breaking risk rules even once can undo years of discipline. His biggest losses came not from bad analysis, but from abandoning his own principles. He knew the rules. He taught the rules. Yet, like many traders, he sometimes failed to follow them. The market showed no mercy. Jesse Livermore's 12 risk management rules are not outdated theories from a bygone era. They are psychological truths that apply today more than ever. Technology has changed, but human behavior has not. Fear, greed, hope, and overconfidence still dominate decision-making. Livermore's legacy is not about how much money he made. It is about what he learned the hard way. That survival is success, and risk management is the price every trader must pay to stay in the game. In the history of financial markets, very few names carry the weight that Jesse Livermore's does. His story is often told as a tale of spectacular fortunes made and lost, but focusing only on the money misses the real lesson. Livermore was not important because he got rich. He was important because he understood something most traders still ignore. The market does not reward prediction, it rewards survival. From the very beginning of his career, Livermore learned that the market is not a place of certainty. It is a place of probability, emotion, and constant change. As a young trader, he experienced early success that gave him confidence, but it was his failures that shaped his philosophy. Every major loss taught him the same lesson in a different form. Profits mean nothing without risk control. Livermore believed that most traders approach the market backwards. They start with profit targets, dreams of wealth, and expectations of quick success. Risk is treated as an afterthought. Livermore reversed this mindset. He started every trade by asking a single question: how much can I lose if I am wrong? Only when that answer was acceptable did he consider entering the trade. This approach was radical at the time. Many traders believed that confidence and boldness were the keys to success. Livermore believed that restraint was far more powerful. He understood that the market could remain irrational longer than any trader could remain solvent. No matter how strong an opinion seemed, the market always had the final word. One of Livermore's core beliefs was that trading was a business, not a game. Losses were not failures, they were operating expenses. But like any business, expenses had to be controlled. A business that allows costs to grow unchecked eventually collapses. Trading was no different. Risk management was the accounting system that kept the business alive. He strongly believed that being right was less important than managing losses. A trader could be wrong many times and still succeed, as long as losses were small and controlled. But a trader who was right most of the time could still fail if losses were allowed to grow unchecked. This truth contradicted the ego-driven mindset of many market participants. Livermore also understood that emotional decision-making was one of the greatest risks a trader faced. Fear, greed, hope, and regret constantly interfered with logic. After a loss, fear could cause hesitation. After a win, greed could encourage overconfidence. Livermore worked tirelessly to remove emotion from execution by relying on predefined rules. One of the most dangerous emotional traps he warned against was revenge trading. After losing money, many traders feel an urge to immediately recover their losses. This leads to impulsive trades, larger position sizes, and ignored risk limits. Livermore recognized this behavior as self-destructive. He believed that after a loss, the correct response was reflection, action. Patience was another pillar of his philosophy. Livermore famously said that it never was his thinking that made the big money, but his sitting. He understood that opportunities in the market were unevenly distributed. Long periods of boredom were often followed by short periods of clarity. Trading constantly increased exposure to unnecessary risk. He also believed that timing was a form of risk management. Entering too early increased uncertainty. Entering too late reduced reward. Livermore waited for confirmation before committing capital. He did not attempt to anticipate the market. He reacted to what it was clearly doing. This reduced guesswork and aligned risk with observable behavior. Flexibility was essential to his survival. Livermore never married a position. If the market changed, he changed. Stubbornness, in his view, was one of the most expensive traits a trader could possess. Holding on to a losing trade out of pride was not strength. It was weakness disguised as conviction. Another critical aspect of his risk philosophy was knowing when to stop trading. Livermore understood that after major wins or losses, judgment was compromised. Emotional highs created overconfidence. Emotional lows created desperation. In both cases, stepping away from the market reduced the risk of self-inflicted damage. Livermore also warned against over-leveraging. Leverage magnified both profits and losses, but losses always arrived faster. Excessive leverage removed flexibility and forced traders to react under pressure. He believed that leverage should be used sparingly and only when conditions were exceptionally clear. He emphasized the importance of mental capital alongside financial capital. Stress, fatigue, and emotional exhaustion were hidden risks that slowly eroded decision-making ability. Livermore treated rest and detachment as part of his risk management strategy. A tired mind made expensive mistakes. One of the most painful truths of Livermore's life was that knowledge alone was not enough. He understood risk management better than most, yet he still suffered catastrophic losses when he ignored his own rules. His story proves that discipline is not a one-time decision. It is a daily commitment. Livermore's failures were not caused by flawed ideas. They were caused by moments of overconfidence, impatience, and emotional vulnerability. The market punished those moments without hesitation. This is why his story is so powerful. It shows that even the greatest traders are not immune to human weakness. His philosophy teaches that profit is a consequence, not a goal. When traders focus on profits, they take shortcuts. When they focus on risk, profits emerge naturally over time. This shift in mindset separates professionals from gamblers. In modern markets filled with noise, speed, and endless information, Livermore's lessons are more relevant than ever. Technology has changed execution, but psychology remains unchanged. The same emotions that destroyed traders a century ago are destroying traders today. Jesse Livermore built his philosophy around one simple truth. You cannot control the market, but you can control your risk. Those who understand this survive. Those who ignore it eventually disappear. History of financial markets is filled with brilliant minds, bold predictions, and dramatic stories of success and failure. Yet among all hose stories, Jesse Livermore stands apart. Not because he predicted markets better than others, but because he eventually understood a deeper truth. Prediction is powerless without risk control. This belief defined his trading philosophy and remains one of the most important lessons for traders today. Livermore learned early in his career that the desire to predict the market is rooted in ego. Traders want to feel smart. They want to call tops and bottoms. They want recognition for being right. But the market does not reward ego. It rewards discipline. Livermore discovered that prediction creates attachment, and attachment increases risk. He realized that every prediction carries an emotional commitment. Once a trader believes strongly in an idea, they begin to defend it. When the market moves against that idea, the trader doesn't immediately exit. Instead, they justify, rationalize, and hope. Hope, Livermore believed, was one of the most dangerous forces in trading. Rather than predicting, Livermore chose to observe. He watched price behavior, volume, and trend. He believed the market revealed its intentions through action, not opinion. By reacting instead of predicting, he reduced unnecessary risk. He let the market confirm his ideas before committing significant capital. Livermore understood that being wrong was inevitable. No trader, no matter how experienced, could avoid losses entirely. The difference between success and failure was not accuracy, but damage control. Losses that were controlled became manageable. Losses that were ignored became catastrophic. One of his core beliefs was that overconfidence was more dangerous than ignorance. After a series of wins, traders often feel invincible. They increase position sizes, loosen rules, and take trades they normally wouldn't. Livermore experienced this firsthand. Some of his biggest losses came after periods of extraordinary success. He learned that risk control must be constant. It could not be relaxed, even temporarily. The market only needs one moment of carelessness to erase years of progress. Discipline, therefore, was not a phase, it was a lifestyle. Livermore also believed that markets punish stubbornness. When traders become emotionally attached to predictions, they resist change. They hold losing positions longer than they should. They increase risk instead of reducing it. Livermore believed that flexibility was a survival skill. If the market changed, the trader must change as well. Another key aspect of his philosophy was understanding uncertainty. Livermore accepted that the future was unknowable. This acceptance freed him from the illusion of control. Instead of trying to eliminate uncertainty, he learned to manage it through position sizing, stop losses, and patience. He emphasized that risk is not just financial, it is psychological. psychological. Fear causes hesitation. Greed causes excess. Regret causes revenge trading. Livermore believed that emotional instability was a hidden form of risk that destroyed traders slowly and silently. To combat this, he relied on rules. Rules removed decision-making from emotional moments. When a stop was hit, he exited. When conditions were unclear, he stayed out. These rules acted as a barrier between emotion and execution. Livermore also believed that not trading was often the best trade. Many traders feel pressure to always be active. Livermore ejected this idea. He believed that forcing trades increased exposure without increasing opportunity. Waiting was not weakness, it was discipline. He treated trading as a long-term endeavor. Short-term excitement meant nothing if it jeopardized long-term survival. Protecting capital ensured that he could continue playing the game when real opportunities appeared. One of the most important lessons from Livermore's life is that knowledge does not guarantee discipline. He understood risk control better than most, yet he still broke his own rules at times. His failures were not due to lack of understanding, but lack of execution. This makes his story especially powerful. It shows that even the greatest traders struggle with human nature. The market exposes weakness without mercy. It does not care about past success or reputation. Livermore's final years are a reminder that ignoring risk, even after mastering it, can be fatal to a trading career. His life demonstrates that discipline must be renewed every day. One lapse is enough to undo everything. In today's markets, filled with leverage, speed, and endless information, Livermore's lessons are more relevant than ever. Traders are encouraged to predict, to react quickly, to chase opportunities. Risk management is often treated as boring or secondary. Livermore would argue it is the only thing that matters. He believed that profits are unpredictable, but risk is controllable. You cannot control outcomes, but you can control exposure. This single idea separates professionals from gamblers. Jesse Livermore's greatest contribution was not a strategy or a system. It was a mindset that prioritizes survival over excitement, discipline over ego, and risk control over prediction. Those who understand this lesson stay in the game. Those who ignore it eventually disappear.